Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Long Verticals and Diagonals. And today we're going to be talking about steps that a trader might take to improve the odds of success on a vertical spread. Now, I'm going to be talking about one step that some traders take that they hope improve the odds that may actually not do that. But then we're going to be talking about two additional steps that a trader can take that actually do directly impact the odds of success. Talk about the pros and the cons of doing that. Should be a lot to discuss. I'm looking forward to it. But before we get into that, let me first of all say hello to everybody out there in YouTube. Hello there, Will and Janelle, Scott, Amy, Harley 3000, Randy, George, Ted, Naresh, Jack, Sandeep, everybody else. Thanks for joining us week after week. We really always do appreciate your attendance, your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the show, but be aware that you're invited to join us in the live presentation. This is a webcast that happens on Thursdays, and it kicks off promptly at 11 Eastern time. We'd love to have you here in the live audience. Also want to let our live audience members know that Connie Hill is joining us in the chat. She's a good friend of mine. I've been working with Connie for a couple of decades now. She's a great coach, brings a wealth of knowledge and experience to this discussion. So thanks for having my back there, Connie. Connie's just going to address any questions that I can't get to during the flow of the presentation, as long as they're relatively on topic. Connie's there to pick up my slack for me. Thanks, Connie. Also, Connie and I would like to issue an invitation to everybody listening, whether live or on the archive. If you're not following us on X and you have an account on that platform, give us a follow. That's the best place to connect with your favorite presenters. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. But let's get into it. And as we do, of course, we need to first pause to consider the risks associated with trading. Certainly applies to options. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about what we're going to talk about. A few things that I want to cover as we spend our 45 minutes together. First thing that we're going to do is take a look at existing positions in our example paper money portfolio. We have 5 current positions. We're going to get a quick update on how those are performing, see if there's anything that needs to be addressed with those. And I think there is one in particular. We need to do something with it today. So we'll talk about that. Then we're going to take a look at current market conditions and begin to put ourselves in the shoes of a vertical spread trader who's trying to plan a new trade to be added to a portfolio. We're going to talk about how market conditions might be used in the planning of that trade, but I also want to give particular emphasis to steps that a trader might take specifically to increase the likelihood of success on that trade. Now that sounds terrific. That sounds like something that everybody would want to do, but there are pros and cons to increasing the probabilities of success on a vertical spread. So we'll talk about that, but specifically before we're done, we're going to talk about 2 things that a trader can do to increase those chances for success. All right, increase the probabilities on a vertical spread. So let's go right to the Thinkorswim platform. Let's have a look at our 5 current positions in our long verticals and diagonals portfolio. And all of them right now doing just fine. As a matter of fact, this Broadcom position has really had a nice reversal of fortune just today. If you'll notice, our profit or loss for the day is about $1,100. We are about $1,000 underwater as of yesterday, but this thing is finally cooperating, seeing an unrealized reversal of about $1,100 today. So what's going on with AVGO? Well, if we open that trade up, we can see that we have a long call vertical, bought the 220s, sold the 225s. In this case, we prefer to be above 225, and that's just where we are right now. We're actually closer to 231, so $6 beyond where we really need to be in that maximum theoretical gain territory come the 21st of February. We weren't there just a short while ago. Let's go to our charts and look at AVGO. We initiated this trade right here on January 16th. Initially, trade was going just fine. We'd like to be above 225, which is right down here. Our other strike is right here. If you're wondering where the green and the red and the blue came from, I just drew those in. manually drew in some boxes, manually drew in some lines just to help us keep a visual reference point of where we'd like to be. So trade was initially going well. This is a bullish trade, but then we had a big overnight drop put us right down into our maximum theoretical loss territory. And this is a good lesson for how some traders, we have the impression sometimes that if we're up in max theoretical gain territory, why are we not at maximum gain? And if we fall down into max theoretical loss, why are we not immediately at max theoretical loss? Well, we need to let, in both scenarios, time work. All right. And in this case, we took a big drop down. It put us down where we didn't want to be, but we held on. Let's see if we can get a snapback recovery. And that's just what's happened. So here's where we find ourselves now. We're working in the right direction again. We're getting closer to expiration. This trade is now cooperating. Look at that. It's right at break even at the moment. So time still needs to work to help this thing out. Not making money, not losing money right now. We'll let it work. With Cisco, this is another long call vertical where we bought the 60s, sold the 62.5 calls. This one was done with a low probability of success. This is one where it's sort of the opposite scenario of what we're discussing today. We had a discussion about how can we increase the profit potential of a trade, put the emphasis on the reward potential of a trade, and we did just that. And what we had to settle for was a low probability of success. Anyway, when we buy the 60s and sell the 62.5s, that means that come the 21st of February, we'd like to be above 62.5. And we're getting close. We didn't start close, but it's working in the right direction. Let's look at Cisco. So with our Cisco trade, we took the trade down here when the stock was down around $59. And for this to work out optimally, we need to get up above 62.5. So there's our preference to be up here, and you can see we're right up there. It's definitely been cooperating. We had one day that was rather uncooperative. Other than that, we've pretty much seen things moving mostly in the right direction. There's just a little bit of time left on these contracts. We have 15 more days before expiration, and we'll see if we can get up there into max gain territory. But even now, we're profitable on this trade, up $900 on 15 contracts. I'm going to let that one continue to work. We'll circle back again next week, see if it's continued to push a little bit higher. Of course, it could sag back, and that would chip away at this $900 unrealized profit, could even put the trade into loss territory. With Gilead Sciences, we bought a long-term $95 call. This was the 17th of June of 2027. Bought that $95 call, so for the next couple of years, or for the next 861 days, we have the right to buy shares for $95. That's great. We'd like to see the stock go up. But just for the short term, we sold the 21st of February of this month, sold a short call at the 100 strike. So here we have the preference for the stock to go up to help out our long-term call, but stay below 100. So hopefully that short-term call can just expire worthless. So let's look at how that's doing. So we'd like this to go up above 95, stay below 100. And right now it's closer to 99. That's just what we would hope for. So looking at Gilead, long call right down here. Here's where we initiated the trade. We'd like to see this go up, but stay below that 100 level. And that's just what it's doing. Jerry says, when do you roll when a trade is not going in the direction you want? It's a good question, Jerry, and we will be doing some of that. We have one trade, we'll talk about that in just a moment, where we initiated the trade with the plan to remain in it for the entire year. And I'm pretty confident that that's going to require some rolling. Rolling just means getting out of one contract and getting into another one using the same order ticket, basically. Jerry, that's sort of a topic for conversation for an upcoming webcast. It needs to be addressed in good detail, and so I'm going to dedicate a webcast to that later. Okay, but for right now, Gilead's doing just what we would hope. We're going to leave that one alone. Let it continue to work. It's profitable. NVIDIA is the one that I thought we need to give some attention to today. With NVIDIA, we bought a long put spread. Bought the 153s, sold the 150s for the 21st of February. In this case, what we'd like to see is for the stock to go down below this vertical spread, or in other words, below 150. And you can see right now we're at 127. Stock has plummeted since we took this trade, which is just what we might have hoped for. So let's go have a look at it. And by the way, for each of these trades, if you want to see the setup, the discussion for the trades, you can just go back to our webcast series. Let me show you that. Make sure you subscribe to our Trader Talks channel, because this is where we host the playlist for our previous webcasts. But you can go to the playlist and then scroll down. You'll have to look for it a little bit, but you're going to be looking for long verticals and diagonals. It's going to be right down there. There it is. So if you look at that full playlist, you can see those previous webcasts, including, to go back to Jerry's question, the discussion that we had, what if an options trader stuck with the same trade for an entire year? That's going to be that that long call diagonal that we took, and we're going to be rolling that throughout the year probably. So let's go back to our current positions. With NVIDIA, though, the 150, 153 puts, we paid a net of $2, 10 minus 8 is 2, to get into this trade, hoping for it to grow in value to as much as $3. And if you look at the difference between the two strikes now, it's now 26.20 minus 23.20. By my math, that's $3. This thing has essentially capped itself out, or it's very close to its maximum gain. It was also in this scenario last week. What we decided to do was we actually exited most of the position last week, but we left 5 contracts in place just to see if anything else interesting would happen. It's nice that it continues to cooperate. It's not significantly different from last week. So I think what we're going to do is just wrap this thing up. Let's see if we can exit with most of our planned original gain. So if we're hoping that we could sell out of this for $3, and maybe we can sell out of it for $2.90. That would still be 90% of the original planned profit. If we're thinking we can make $1, we can make 90 cents right now. Still 90%. Let's get rid of this. Let's close it out. Right click on NVIDIA. Let's create a closing order to sell that vertical. And it looks like, oh, look at the natural. It's bouncing around quite a bit. Actually, 230 to 275. I don't know if I'm quite thrilled with that. Let me take a look at NVIDIA. I may hit the pause button on this exit. Yeah, see what's happening here is the stock is rallying, which is reducing the profitability of this bearish trade. That's what's happening as we speak. We had last week we were here, continued down, but a pretty sharp rally over the last 4 trading sessions. Now, we might come up and bump our heads against this 130 resistance and pull back, maybe give us a better opportunity to let time work for this trade. I'm kind of thinking I was going to get out of this trade, but I don't know. 26, it's a pretty good spread. What's happening here is we're encountering the bid-ask spread here. Let's see. 292, it's creeping up there. Here's what I'm going to do. Let's dial this down and say, you know what? If we can get out for 280, that's 80% of the most we could have made on this trade theoretically. Might not be $3, but it's 280. Bought at $2, out at 280. Okay. Let's see if we can get at least that. I'm going to leave that as a limit. There's no guarantee that we're going to get it, but let's see if we can. Close out for those 5 contracts, or those 5 contracts, or the 153, 150 put vertical, 280 limit, max gain, max loss. These would be as if this were an opening transaction. It's not. It's a closing transaction. CS says the MACD is heading down on NVIDIA, so maybe that's at least one technical indication that that this price might start to cooperate as well. But let's see if we can get filled. If we do fill, there would be a commission here, $6.50. Which would reduce the net credit received. But let's send this order off and see. When we enter a limit order, there's never a guarantee that that order is going to fill. I think we have pretty good chance here, though. It looks like the current mark. Yep. Wow. Okay. Out for 295. That was better than I might have hoped. So our theoretical best exit would have been $3. We got out for $2.95, so we left 5 cents on the table. On 5 contracts, that'd be $5 per contract. We left $25 there. But we're done. There's no more risk in that trade. That is now a realized gain. We banked that one. That's great. But that leaves us with 4 positions, including United Health. So United Health, we bought the 520 call. Is this the one? Let me click on this. Yep, January 9th. This was the one where we were having this discussion back here. What if an options trader stuck with the same trade for an entire year? This was our trade here. But we bought a long-term call, and we're selling shorter-term calls against that. With this, we prefer for the stock to go up as far as it can above 520, while remaining below 560. And I think this was at 540 yesterday. So yeah, we're sagging back about $10 today. That's not really what we'd like to see for this trade, but overall trade's still profitable. Let's look at UNH. So we bought a long call here, and you can see prices have net risen a bit. That's been helping out that long call. But also we sold a 560 short call. So as long as we're below that 560, we should be in good position. But hopefully this contract at this expire worthless. Now, even out of the money, short contracts can be assigned. If the other trader gets a wild hair and they say, hey, Cameron, even though the shares are only worth 530, I'm going to pay you 560 for those shares. Okay, they can do that. That's their choice. It's just not as likely. So overall, the trade's doing okay. It's profitable, I would say marginally at this point. We're going to let that one continue to work. So there we go. We've looked at our existing positions. Time to add a new position. So we're going to be building a new vertical spread here. We're going to be deciding whether to be bullish or bearish with that. But with an emphasis on how might the trader increase the probabilities of success on however they structure that vertical spread. So let's quickly make a decision here. Should we do a bullish or a bearish vertical spread, a long call vertical or a long put vertical? Well, it's something that might help a trader to make that decision is to look to see what's going on with the markets broadly. And over the last 12 months and extending well beyond that, it's been a pretty bullish market. Obviously, there have been bearish times, but have typically lasted only about a month or so. And other than that, prices have persisted higher. And let's say that our trader is trying to decide on a new trade out here in March. We already have several that are expiring in February. So let's look out here to March to add something. All right. And let's say that our hypothetical trader is looking at technical evidence here, and they might say, well, the trend is upward. So trying to trade bearishly, even though we've done okay, we did okay with that NVIDIA trade that was counter the trend of the rest of the markets. I think we might have gotten a little bit of a nice break on that one. I actually expected to lose money on that. We just did pretty good. Anyway, let's say that our trader thinks that the markets still look bullish. Making higher highs and higher lows, a recent pullback may just be another retracement in the short term, and they think that we're likely headed higher. Well, in that case, if they're making a choice between a long call vertical and a long put vertical, they might lean right toward that long call. Now, as we start to structure this long call vertical, and I think what we're going to use here is as our example is going to be Microsoft. So here's Microsoft. I wanted to talk about one thing that some traders will do in an effort to increase the mathematical probability of success on their trade. One thing they do is they look at a chart. And here I'll have to say, chart analysis might help, but there's actually not always a direct correlation between the chart analysis that the trader performs and the probabilities of success on the trade. They think that they're helping, they hope that they're helping, but it's tough to quantify. So let's do some chart analysis on this trade. Okay, here's what's been going on with Microsoft. If you look, you'll notice Microsoft has been running up and pulling back and running up and pulling back and running up and pulling back. Seems to have a price ceiling up here between 440 and 450, at least for the last 5 or 6 months. And then there's been a price floor down at around 410, 408, something like that. You'll notice there's been very little trading activity down here. So possibly what's going on is there are traders hanging out in the wings here who are looking to buy at lows, and every time they do that, drives the price back up again. And so the trader might be thinking to themselves, I think there might be something I could do here to increase the probability of success on a trade. I wonder if I could set up a trade, my vertical spread, so that as long as we're above maybe 408 or 410, as we move toward March 21st, which is what we've been above for a long time now, as long as we can just be up there still, maybe I've improved the odds of my trade. That's possible, but the stock can still do whatever the stock wants to do, right? Yeah, using chart analysis, conceptually, the trader is doing this, hoping to improve the odds of success. And maybe it works and maybe it doesn't, because here's the difficulty with chart analysis. It is largely in the eye of the beholder. Now, have I made a pretty good case that it looks like this is a pretty good price floor, and that therefore maybe there aren't strong odds that we're going to wind up below that price floor on the 21st of March? Maybe I did, maybe I didn't. But that's still just one observation. Somebody else might look at this and say, sure, it looks like there's been a price floor, but boy, the momentum has been largely downward for the last 8 weeks, and they might see this as a downtrend that's likely to just continue down. Yeah, technical analysis can be largely in the eye of the beholder. But I'm just going to go on the assumption here. Let's just say that our trader is pretty convinced. The chart looks good. It looks like this support is likely to hold. And so let's structure a trade in the interests of improving the odds of the trade down below this support. So that if we're above that, we still stand some good odds for success, hopefully. Let's go to our trade tab. And I'm going to start to structure this trade. But I also want to use the actual math of options to assist with this trade. And the first thing that we're going to do to actually improve the odds of success is use the delta over here. Okay? So what is delta? Well, there are a couple of different potential interpretations. Delta can show the potential leverage of the trade. How much can it make, or how much can a contract make or lose as stock price rises or falls? Well, it may also show us the relative likelihood that an option expires in the money at expiration. So for example, if we look at the 410 call, it has a delta of 65. To some traders, that means there's about a 65% likelihood that that option will be in the money at expiration. And if their objective for that option is to be in the money, well, that's a comparatively high probability, 65% odds. And actually, with a long call vertical, being in the money at expiration is exactly what most traders have in mind for that trade. So if we choose deltas above a 50, then that means that we have a better than 50-50 chance on this trade. The higher the delta, the higher the probabilities of success. So trader says in the money, low probabilities. That would be true if we were selling vertical spreads. In this case, we are buying them. Yep. So in the money actually carry higher probabilities of success. Or in other words, higher deltas carry higher probabilities of success. So sort of begs the question, why don't we just go way up here and get an extremely high probability of success? What's the trade-off? In options trading, as with most ways that we invest, there's a teeter-totter effect. If something is positive about one decision, there's likely to be a risk associated with that. What's the trade-off with going with high probabilities of success on a vertical spread? The reward potential of the trade goes down. If the likelihood of success goes up, the reward for being successful goes down. So the trader is just looking for the balance of how much probability they need to feel comfortable and how little of reward are they willing to settle for in pursuit of that probability. That's it. So, you know what I'm going to do for today's example trade? I want to look at maybe even the 400. Let's see if we can. Yeah, that looks like that might work. I'm going to look at this $400 call and the 395. So this is going to be our example trade. So if we're looking at the 400 and 395, we're dealing with probabilities around 82% and 77%. But this is going to be our example trade for the day. Long call vertical. Not vertical, vertical. Let's make this bold. It's just kind of fading into the background right now. There we go. For today's example, we are going to buy the 21st of March 395 call for, that looks like it's trading between 28.10 and 28.40. If we sort of split the difference, that might have us around, let's say it costs us 28.30. Okay? And then at the same time, we're going to sell the 21st of March $400 call for, and it looks like it's trading between 23.95 and 24.40. All right, let's say we can get 24.20. See how that's right in the middle right there? There we go. That's going to be our example trade. And the reason I chose this is because those deltas are high. With this trade, if we were to structure it this way, Sam says, what's your opinion on Leaps? Sam, I never offer opinions in my discussions. I only offer education. But Leaps are included in some of our trades when we do diagonal spreads. We've done a couple of those Leaps contracts, but just to quickly define them, a Leaps contract just means long-term equity anticipation security. It's a fancy name saying this is a long-term option. And basically, there isn't any real, other than carrying a fancy title, and I've been doing this for a long time. It's been a couple of decades now. I've never discovered why they deserve their own fancy title. It just means they're longer term than other contracts. Nothing else unique about them. There we go. That's just sort of a statement of truth about how, Leaps contracts. What should we call the shorter one? Lumps? I don't know. Anyway, yeah, we do longer term contracts from time to time in this webcast series. But if we structure this trade this way, here's what we're actually doing. We're paying some money for the right to buy shares for $3.95, and then we're receiving some money for the obligation to sell those shares for $400. Now, the net is that it's going to cost us, about 90 cents? $1.10? Yeah. It's going to cost us about, $4.10 to set this thing up? Yep. What's the net cost here? Net cost, also the theoretical maximum loss of this trade. Is $4.10. Here's what I should always do before I start doing math in my head. I should finish my original thought. I was still thinking about Leaps while throwing out an answer here. Jack says, seems like most of the coaches choose the strike at the money. Maybe or maybe not, Jack. It should always be seen as educational purposes only, because there are pros and cons to every strike combination we could choose here. So I would never make the case that this is the right combination for anyone, because going in the money, choosing a higher delta, as we've already discussed, increases the probability of success on the trade, but at the same time, it also lowers the reward potential. There are some traders that say, Cameron, you are selling yourself short here. If you're spending $4.10 to set up a trade that might turn into $5, because that's what this could do, if these contracts are ultimately assigned and exercised, if they both wind up in the money at expiration, well, we wind up buying the shares for $3.95, selling the shares for $4. That would be $5 of profit if this were a free trade, but it's not a free trade. It cost us $4.10 to set this trade up. And Jim has done the math already and say, Jim, so we're risking $4.10 to make $90? Yeah. Yep, because the probabilities are there. For some traders, they're like, that's fine. Actually, there are lots of trade. Let me throw this out there. I don't know if I want to do that. But there are lots of things that we do with a very high probability of success. Now, let's make this analogy for just a moment. If we were to, let's say, buy a short-term government bond, a T-bill, okay? Let's say we put $100,000 into that T-bill, and it's offering, who knows, 3.5% return. 3.5% is a relatively small reward potential. Theoretically, what could happen to our $100,000 investment? What if the government defaulted on their bond issues? We could lose the $100,000. And some traders would say, yeah, but Cameron, that's not going to happen. There's still a possibility. With investing and with trading, typically when we have a high probability of success, as with a government bond like that, there is an associated very large risk, even if it's remote. Yeah. So, yep, that's the way this works too. The probability of success is way up there, but the reward isn't nearly as big because of that. So, yep, we're risking 410. How much could we make? Well, the theoretical max gain on this trade is $5. If we wind up buying the shares for $3.95, selling them for $400, that's a $5 gain, except it cost us $4.10 to set this deal up. So that actually leaves us with 90 cents that we could make. Or on 100 shares, $410 at risk, $90 that could be made. Okay, so all right, let's get back to this trade in just a moment, because I just noticed something. There's been a survey that's been added to the chat window here. So that's for the benefit of those that are here in the live stream audience. Do me this favor, if you would click that survey link right now, it'll activate the survey, and then you can fill it out after we're done with our webcast. You can give me some honest feedback. I'll just tell you a couple of things about that survey. Number one, it's a really short, quick survey, 2 multiple choice questions. It could just be click, click, and you're done. But there's also a comments box and a suggestion box if you want to give me some additional suggestions. What I'll say is, if you take the time to fill out that survey to whatever extent, I will take the time I always read through that data. I read through the comments, and it always helps. So thank you for doing that. You're definitely providing a service to your presenters by filling out those surveys. Anyway, back to our trade here. We're now seeing the math of this trade. What do you suppose would happen to the amount risked versus the amount of potential reward if we were to go for an even higher probability trade? Because this is the first step that a trader can actually take, where we do increase the probability of success on a trade. And that is going for higher delta contracts. In other words, we're moving our strikes lower and lower and lower on this example. Well, the further we go, the higher the delta, the higher the probability of the trades, the lower the reward potential. Right now it's 90 cents. If we were to go up to, let's say, the 390 and the 385, it's going to be even less of a potential reward. All right. So there are pros to increasing probability. That always sounds really attractive. Oh, what we'd really love to have is a trade with a 100% chance of success, no chance for failure, and an extremely high reward for being successful. I can't deliver that sort of a thing to you, but I can tell you how to increase the probability of success. And the trader just needs to decide for themselves, where are they finding that balance between probabilities and reward potential? Because a trader might look at this and say, you know what, the trade as Cameron structured it has a 76% chance of success. But you know what, I might be okay with a 71% chance. Instead of doing the 395 and the 400, maybe we do the 400 and 405. That's actually going to start to increase the reward potential for taking a larger risk. Randy says, Cameron, you feel in this case the long call vertical is better than the short put vertical? No, Randy, I don't. No, That's a good question, but this webcast series is just called Long Verticals, so I don't talk about short verticals. But I'll give you this very quickly. Long call verticals and short put verticals done at the same strikes are effectively the same trade. Very, very nominal differences between the two. The probability is going to be the same. The reward and risk potentials are going to be very similar. All of those, where the break-even points are, the chart bias, all of that is going to be effectively identical. So one thing that can change is the likelihood of early assignment. But Cam says, isn't the 400 call in the money creating an assignment risk? Another good question. The one thing I want to do is let's put the word risk in air quotes. What does the trader want from this trade? They want assignment. So what's the best case outcome from this trade? Well, if we're above 400 as we get to expiration, let's map this out. Let's actually put this on a chart so we can visualize it a little bit more readily. Let's draw in a line. So here is where we're taking our trade on this date. Here are our strikes. We chose the 400 for this example. We chose the 400. Let's go right down there as close as we can. There we are. Carry that out to the expiration right there. And then let's go down to the 395, which is going to be right here, and carry that out to expiration. Pop that right there. So those are our two strikes. And for this trade to work out optimally, to be in position for its maximum theoretical gain, we'd like to be up here. Anywhere up here as we move out toward that expiration. Notice where we are right now. We're already up in that maximum theoretical gain territory. So if a day goes by and we don't move, we're just closer to expiration. That's great. But if we are still in the same spot, if the stock's still worth, 417, 420, 450, if the stock is up here, what happens with the two contracts at expiration? Well, yeah, and AJ, you've asked a great question. I'm glad you asked it. But someone has the right, we have the right to buy shares for $3.95. If those shares are worth more than $3.95, and we allow this to get to expiration, those contracts are just automatically assigned on our behalf because there's value in that. If the shares are worth $400, or let's say they're worth $415, and we have the right to buy them for $3.95, yeah, we buy those for $3.95, but then oops, someone else grabs those same shares from us for $400. That's a $5 realized gain on the stock trade. But it cost us $4.10 in net premiums to set up that trade, so that would result in a $90 gain. Yeah. Assignment of these contracts, assignment of the short, and exercising the long results in theoretical maximum gain being realized. So yeah, if that happens before expiration, all that means is that we got our maximum gain faster. Trader says, do you have a scan to find this trade? I could, but actually all we did is we just found a stock that appeared to be bullish and then went and set the trade up using the options. So no, there wasn't anything that I did to scan for it other than just look at a chart. Okay. But this trade could fail. It's just not very likely to. How could it fail? Well, if the stock were to fall down below 395, let's draw in a line there. If it were to fall down here by expiration, that is where we might be in our maximum loss territory. In that case, these contracts don't get assigned and exercised. They just expire worthless. And having something we paid $4.10 for expire worthless is not fun. So let me just edit the properties of this drawing. This is going to be our max loss territory. Okay, so let's talk about reducing the probability of that scenario in a different way. And I wanted to talk with you about time. One thing that we've done is we've talked about price. Choosing strikes can change the probability of success, but so can time. Yeah, Frankie says, what about time decay? Time decay is working in the favor of this trade, Frankie. Imagine we had set this trade up and there are only 5 minutes until expiration of these contracts. So all the stock had to manage to do was not fall down below 395 bucks in the next 5 minutes. That would be an extremely high probability scenario. Now there's a trade-off there. Probably wouldn't get $90 of reward in that kind of a scenario. But time definitely can change the probabilities of success on a trade. So what a trader might be looking for in choosing their vertical spread is to find an adequate reward versus risk, but also not giving the trade too much time to misbehave. Now, I said 5 minutes just as an extreme example. What if we were in this trade with the likelihood, the chance to maybe make 90 bucks, but we had to sit on it for 5 years? Or more specifically, the stock needed to stay above $400 for 5 years. If we give the stock a long time to work, it becomes less and less predictable in a mathematical sense. Typically, with a trade that's already where we need it to be, and this trade is already where we need it to be, the trader will want to minimize the time till expiration because the objective here is to get to expiration without the stock misbehaving. The more time we give it, the more time it has to misbehave. Okay? So the second thing a trader can do is just minimize that time till expiration. But it has the same impact if we go for a very short period of time. Let's look at, what if we just did the 21st of February instead of the 21st of March? Give it only 15 days instead of 43 days. The probabilities go up, but the reward for success goes down. So in this case, we're seeing, it could cost us more like $4.25 to set up that trade. So there we go. 2 steps that can be taken that actually improve the probabilities of success on a trade. Number 1 is that strike selection, going deeper in the money with these spreads, going for that higher delta can increase the likelihood of success. Also, reducing the period of time till expiration when we've gone for that high probability scenario can assist. Ted says, if a sold call gets exercised, will a long call be exercised to cover that? Ted, only if we choose to before expiration. At expiration, all in the money options are assigned unless there are explicit instructions left by the owner of the contract to not exercise. Okay? Yeah, before expiration, if the short call is assigned, we can, if we want to, exercise the long. Not required to, because it may actually be mathematically a more profitable thing to sell that long call and then to buy out of the short stock position. All right. Anyway, let's place our trade. Let's go to the 21st of March. I'm going to set up our vertical spread. Let's just come up here where it says spread single. It's showing us all the single strikes. I'm going to click on vertical. There it is. And look at our 395, 400. Click on the ask price to create that buy order. And let's say we're now willing to pay, well, let's go right up to 410. There we go. That's what we've been running our numbers on. Let's go for 410. We'll set that as our limit. And let's do 10 contracts. In this webcast series, we've typically been investing about $4,000 in each trade. And let's click confirm and send. Buying those 10 verticals, 395, 400 calls for a limit of $4.10. That would be a $4,100 maximum loss in the trade, a $900 maximum gain. Plus, we got to consider those commissions. Let's send this order off. There we go. It looks like we got it for a little bit less. Great. That leaves more for profit potential. So from here, we'd just like the stock to stay where it is. Go up is fine. Go down is fine as long as it's above 400 at expiration is ultimately objective of this trade. Guys, we have accomplished what we set out to do today. I wanted to take a look at existing positions and see if any of those needed some management. Wanted to take a peek at the markets, set up a discussion for planning a vertical spread, but spend the bulk of our time talking through steps that a trader might take to increase the probabilities of success on a trade. And there's one thing, looking at charts might help, but strike selection and expiration do help as far as one defines help as increasing the probability of success. Of course, increasing probabilities of success also lowers the reward potential. So trader just has to find the combination that fits their preferences. Guys, time for me to let you go. Make sure, as I've mentioned before, that you've subscribed to our Trader Talks channel on YouTube. You can just go down and click on the subscribe button right now. It doesn't cost anything. And this is where we host the playlist for our previous webcasts, and you can join our live streams. Also, if you have an account on X, follow Connie and me there. You can follow your favorite presenters on X. That doesn't cost anything. And it's the best place to connect with us in between the live streams. Connie, thanks for helping out. Everybody, I will see you again next week for another discussion of long verticals and diagonals. We'll be following up on our existing trades and seeing if they need to be changed in the future. I also want to thank everybody for clicking the like button. I can already see out of the 223 people watching the live right now, 87 have already clicked the like button. Thank you. That's very much appreciated. Sounds like applause to us. And it also gives us a boost in the YouTube algorithm to help our webcasts find a bigger audience. Go fill out that survey if you haven't done it already. I will see you at a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.